Investing isn't the problem. The problem is people like to overcomplicate investing. But building wealth is incredibly simple when you know how. There are only two ways you can fail as an investor. The goal is straightforward. Let your money grow through compounding. Now imagine that you start with this full potential to build wealth, but with each mistake, the compounding engine slows down. The only two possible errors you can make are A, a silly mistake, panic selling in a crash, chasing hype, or timing the market, or B, a genuine lack of knowledge. You simply don't know how to allocate, diversify, or manage risk. If you eliminate these two errors, you'll capture the returns the market is already offering. But we can get even smarter than this. Within these categories, there are even more specific mistakes that you could make. For genuine lack of knowledge, is it that you were never taught the basics of compounding? Is it that you forgot what diversification really means? Or is it just that you never built a plan in the first place? For silly mistakes, is it emotional? You panic when prices fall? You get FOMO when markets rise? Or is it physical? You're stressed, distracted, and can't stick to the plan you wrote. People make the mistake of thinking investing is about stock picking genius or perfect timing. But there are a heck of a lot more factors that go into whether or not your wealth compounds. So our equation for today has two variables. Within these two variables, we are going to discuss a variety of different things. Knowledge plus discipline equals lifelong returns. Simple enough, right? The first variable is knowledge, and it is the easiest part to screw up. You might have zoned out the moment someone started talking about ETFs, bonds, or diversification, and suddenly you feel lost. If you find yourself not understanding investing, it's always for one of two reasons. One, you know what to do, but not why. For example, you might know that index funds outperform most active traders, but you don't really understand why. Is it just luck? Is it fees? Is it diversification? Without the why, the rule feels like blind faith. Or two, you don't understand the method at all. You might not know how to build a portfolio, how much to invest, or even which account to use. Here's the truth. Investing is a cumulative subject. It's built in layers, just like maths. If you don't understand interest, you can't understand compounding. If you don't understand compounding, you can't understand why time in the market matters more than timing the market. If you don't understand diversification, you can't understand asset allocation. And if you don't understand asset allocation, you can't understand risk management. Most people skip these building blocks, then wonder why the advanced concepts make no sense. The worst thing you can do is sit in confusion and pretend you understand. Every time that happens, you've got to raise a red flag in your mind. Something has gone wrong and you need to go back and fix the missing building block. The best thing you can do is act like a curious toddler and keep asking why. Why does compounding matter? Why do fees eat returns? Why do broad index funds win? Because the more you understand the why, the less likely you are to abandon your plan when markets get rough. And the way to quickly do that is to keep practicing a lot. But practicing is where most people go wrong. In maths, you'd never just read the textbook and expect to ace the exam. In investing, it's the same. You can't just read books or watch videos, you have to practice. The good news is you don't need millions to practice investing. You can start small, even with just a few dollars. The point isn't the size, it's the repetition. But the worst mistake you can make is to invest, check the balance, shrug, and move on. If you want rapid improvement, you've got to dissect your investing choices like a surgeon. Every time you invest, open a journal and write 3 things. What decision you made, why you made it, what happened. Was it a silly mistake, like chasing hype or panic selling? Or was it a lack of knowledge, like misunderstanding diversification? At first, this feels embarrassing. You'll look back and think, why did I buy that? Why did I sell here? But that embarrassment is the point. It's how you uncover the real causes behind your mistakes. When you start tracking these causes, patterns emerge. Maybe most of your losses come from overtrading. Maybe they come from ignoring fees, or maybe they come from panicking in downturns. Once you know the cause, you can fix it. Practicing isn't about maximizing your returns on day one. It's about building the habits and feedback loops that make your future returns inevitable. Quick note, if you're serious about starting your investing journey, I've put together a free masterclass where I show my full step-by-step system for building your first stock portfolio, avoiding beginner mistakes, and growing it over time. You can watch it anytime using the link in the description. Remembering is the final stage. You can understand the concepts and you can practice them, but if you don't remember them when it matters, all of that work falls apart. That's why investors panic in crashes. In the heat of the moment, they forget the basic truths they already knew. They forget that markets fall and then recover. They forget that compounding only works if you stay invested. They forget that fees and taxes are termites quietly eating away at wealth. So the question becomes, how do you make sure you don't forget these principles? The answer is to build reminders and automation into your system. Automatic investments mean you never forget to contribute. Rebalance rules mean you don't forget how much risk you intended to take. An investment spreadsheet means you don't forget your own strategy when fear takes over. Think of these things as flashcards for your money. Whenever you feel uncertainty creeping in, you flip back to the rules you already wrote down. Your plan exists to protect you from your future self. Because investing, like maths, is cumulative. One forgotten piece, one broken rule, and the whole structure begins to wobble. But if you lock in the knowledge, practice it with small stakes, and remember it through rules and automation, the compounding engine keeps running no matter what's happening around you. A major thing to know is that even with knowledge locked in, silly mistakes still creep in. That's where discipline comes in. Discipline is what stops you from making silly mistakes. It counts as a silly mistake when you already know what to do, but in the heat of the moment, you fail to do it. You know markets recover, but you panic sell anyway. You know fees drag down wealth, but you chase a hot new product with sky-high costs. You know timing the market is a losing game, but you still try to guess the top and bottom. When this happens, you need to ask yourself whether it's a physical issue or an emotional one. A physical issue means your brain simply doesn't have the energy to stay calm. Maybe you're stressed at work, maybe you're exhausted from life, and you don't have the focus to make rational choices. Just like pulling an all-nighter before an exam, you can't expect to think clearly about money when you're running on fumes. An emotional issue is different. It shows up as fear when markets fall, greed when they rise, or boredom when things are flat. It makes you believe you're not good at investing, that you need to do something, even when the right answer is to stay the course. Attention also matters. Investing doesn't require you to stare at charts all day, but it does require you to pay enough attention to follow your plan. If your focus is scattered, you're far more likely to break your own rules. The goal is to get into a state of flow with your investing. That means your system runs smoothly without second guessing. Contributions go in automatically. Rebalancing happens on schedule. You're so in tune with your process that months pass and you barely notice because the system is quietly working in the background. Reaching this flow state can be difficult, especially if you feel resistance toward investing. But once you do, you'll realize that discipline isn't about fighting emotions every day. It's about designing a plan that makes discipline automatic, so you hardly notice you're being disciplined at all. By the way, I wanted to share something useful. Go Login. It's an anti-detect browser that really saves time and nerves in both work and daily life. With it, you can manage multiple accounts on any website, keep your data private, work with a team without sharing passwords, access content from any country, avoid bans and blocks, and much more. Check it out in the link below. So that's it. We've broken investing down into two variables, knowledge and discipline. Knowledge is about understanding the building blocks: interest, compounding, diversification, allocation, risk management. Without these, the advanced concepts collapse. Discipline is about execution. It's knowing the rules and actually following them when it matters most. It's protecting yourself from panic, greed, or distraction. Combine the two, and investing stops being complicated. It becomes a process where you learn the fundamentals, practice with real money even in small amounts, and remember the principles through automation and a written plan. That's why I built the investment cheat sheet with 4 different spreadsheets inside. It's free if you enroll in my free course and join the private community. You will find the link at the bottom of the description below. With this plan in place, you've eliminated the 2 ways investors fail. No more silly mistakes, no more gaps in knowledge, just a system that captures the returns the market already offers. Investing isn't hard, it's misunderstood. And once you understand it, the only thing left to do is stay the course.